What if a global war starts in 2026? Think about that for a second. Would your money survive, or would it just, disappear overnight?
Yeah, it's the kind of extreme hypothetical that honestly keeps institutional risk managers awake at night.
Right. It sounds intense, maybe even alarmist. But that is exactly why we are diving into these sources today. We're exploring a very specific set of notes and strategies about, well, navigating the severe financial hits to your savings, your investments, and your future during global conflicts.
But before we get into the weeds here, I really need to explicitly state to the listener that everything we are discussing in this deep dive is for educational purposes only. It is absolutely not financial advice.
Yes, crucial disclaimer right there. We are analyzing historical frameworks today. Think of it like comparing your financial portfolio to a house in a storm. I mean, you don't wait for the hurricane to hit to go out and buy plywood, right?
Oh, absolutely not. You prepare when the weather is calm.
Okay, so let's unpack this. What exactly is the hurricane in this scenario? If a major conflict breaks out, what does that storm look like?
Well, the sources instruct us to look at historical precedent to really understand this 2026 hypothetical. Specifically, we have to look back at World War II.
Okay, so going back to the 1940s.
Right. It serves as the baseline because it shows us what actually happens in major wars. Economies crash, inflation rises incredibly fast, and daily life just becomes aggressively expensive for everyone.
I want to play devil's advocate here to deepen this a bit because it's really easy to just say, economies crash. But why does a war overseas automatically mean my groceries get more expensive at home? Like there's an ocean between the conflict and my local supermarket.
That is a great question. And if we connect this to the bigger picture, it really comes down to wartime production and resource scarcity.
Because everything gets diverted.
Right. Exactly. When a major global conflict breaks out, governments essentially step in and become the buyer of first resort. They commandeer the supply chains. So factories retool for defense production, but more importantly, governments hoard raw materials.
Like oil, steel, wheat, things like that.
Yes, all the foundational inputs. The civilian market is suddenly starved of those essential resources, but baseline human demand doesn't change at all. People still need to eat and heat their homes.
Wow, okay, so it's not just the classic butter to gun shift, it's the speed of that shift.
Precisely. Plus, you have to factor in the massive disruption of maritime trade. If shipping lanes become conflict zones, maritime insurance premiums just explode. The sheer cost to transport a barrel of oil or a container of grain multiplies, and every single cent of that is passed directly to you, the consumer.
Okay, so the fuel to get the bread to the store triples in price, the wheat to make the bread is being hoarded, and the ships are gridlocked.
Yeah. Which means the inevitable rise of inflation making daily life costly is practically a mechanical guarantee, regardless of where the fighting is actually happening.
So if that is the global weather pattern, if that's the macro historical view, what does this storm look like specifically for Australians? The notes focus heavily on this geographic area.
Right, because an import-heavy regional economy like Australia faces a very specific set of risks. The discussion focuses on four distinct threats-falling markets: rising inflation, job uncertainty, and currency drops.
And these aren't happening in isolation, are they?
No, not at all. They feed into each other in a pretty vicious cycle. It usually starts with extreme global panic, which causes institutional capital to flee regional markets and run to perceived safe havens like the US dollar.
Which acts like a vacuum. It just sucks the capital out, and the regional currency, like the Aussie dollar, just drops.
Exactly. And a currency drop directly exacerbates inflation because Australia relies heavily on importing refined fuel, machinery, tech. All of that suddenly costs way more to bring into the country. You are literally importing inflation.
Oh, I see. Which
Right.
then forces the central bank to step in.
Right. The central bank has to hike interest rates to fight that imported inflation and defend the currency. But doing that in the middle of a supply shock basically strangles domestic businesses. Their borrowing costs explode right as their supply costs are skyrocketing.
So the companies have to cut their overhead aggressively just to survive.
And overhead, unfortunately, usually means headcount. That is where the job uncertainty violently enters the picture. You see widespread layoffs.
Right as the cost of living is hitting a historic high. So what does this all mean for you listening? It means you aren't just fighting one battle. You're fighting a multi-front financial war. It's a massive financial domino effect.
It really is. And as unemployment spikes and corporate earnings collapse, investor confidence disintegrates, which leads to that final domino falling equity markets.
Okay, well, we know the threat now. The picture's pretty grim. So let's pivot.
Mhm.
How do you actually build your financial armor? What's the playbook here?
So the sources provide a really clear four-step defense playbook. You need to build emergency savings, diversify your investments, aggressively reduce your debt, and stay liquid.
Okay, wait, here's where it gets really interesting to me. The sources say to stay liquid, but they also just warned us about rising inflation. Isn't staying liquid just sitting on cash? And won't inflation just eat that cash?
That is the central tension of this whole strategy, honestly. You're hitting on a really nuanced point from the source material. Holding cash during high inflation is, mathematically speaking, a losing trade.
Right, because you're silently bleeding purchasing power every day.
Exactly. But here is the strategic balance. You aren't holding liquidity to generate a return. You are holding it strictly as an insurance policy against forced liquidation.
Oh, I get it. You hold the cash so you don't have to sell your actual investments when the market is crashing.
Yes. Think about those dominoes again. If you face job uncertainty and lose your income, your fixed burdens, like your mortgage or car payments, they don't pause.
And if all your money is tied up in stocks that are down 40%, you have a massive cash flow crisis.
Right. You'd be forced into a fire sale, liquidating your assets at the absolute bottom just to buy groceries. That is how generational wealth is destroyed in a panic. So you maintain enough accessible funds to survive that job uncertainty.
But without keeping so much in cash, that inflation destroys your future. It's a tightrope walk.
It is. You accept the inflationary haircut on that specific emergency fund, say 6 to 12 months of living costs, because it buys you the staying power to leave your main portfolio untouched. Combine that with reducing your debt to eliminate those fixed burdens, and you become much harder to kill financially.
Okay, so that perfectly bridges us to the next topic. If sitting entirely on cash is too risky because of inflation, where should your money actually go during a crisis? We need to talk about the crisis portfolio.
Right, because you have to deploy that capital somewhere safe.
The notes identify some very specific safe havens. I'm looking at gold, essential sectors, dividend stocks, and government bonds. Let's break down why each of these works as a crisis shield, starting with gold.
Well, gold's historical role is fascinating because it is a zero counterparty asset. During a severe geopolitical conflict, paper currencies carry immense risk because they are just promises backed by a government.
And if that government is fighting a massive war, that promise gets pretty shaky.
Exactly. Gold's value doesn't rely on a government's ability to collect taxes or set monetary policy. When capital flees and local inflation spikes, gold historically reprices to reflect that loss of purchasing power.
Okay, so gold acts as a direct hedge. Now, what about the essential sectors?
Well, the reality is that people still need certain things, even in wartime. We're talking utilities, baseline healthcare, consumer staples. You might delay buying a new smartphone if the economy crashes, but you cannot delay turning on your lights or buying your blood pressure medication.
Right, the demand is totally inelastic. The consumer has no choice but to absorb the cost.
Exactly. So the revenue streams for those businesses remain structurally stable, making them a defensive fortress for your capital.
Okay, so that brings us to dividend stocks. How do they fit into this?
Dividend stocks provide a passive income stream during that job uncertainty we discussed. If you hold reliable, fundamentally sound companies that pay a consistent dividend, you are generating cash flow without having to sell your underlying shares.
It's just mechanical liquidity hitting your account every quarter, offsetting the rising cost of living.
Precisely. And finally, we have government bonds, which act as the ultimate safety net.
Wait, but if a government is financing a total war, how safe is their debt, really?
It's a valid concern, but the safety lies in the fact that a sovereign government controls its own printing press. They can always meet nominal bond obligations. During massive market volatility, institutional capital flocks to the guaranteed yield and principal protection of sovereign bonds.
To smooth out the wild swings in the stock market.
Yes, especially inflation-linked bonds, which mathematically peg your principal to the consumer price index.
Man, I love this mix. I look at this portfolio like a wartime survival kit. Gold is the compass that never loses its true north. Essential sectors are your water rations. Dividend stocks are your foraging tools, constantly bringing in small bits of sustenance. And government bonds are the emergency shelter.
That is a perfect analogy. It covers all the mechanical functions you need when the broader systems are breaking down.
But, and there is a massive but here from the sources, you can have the perfect survival kit, but human nature can still completely ruin it. We really need to talk about the behavioral risks and the psychological traps.
Oh, absolutely. The psychological mechanics of a crisis are arguably more destructive than the economic ones. The sources explicitly warn against three major tracks: panic selling, following hype, and putting everything in one place.
I have to ask about that first one. When you're watching the market dropping like a scone, the red numbers are flashing everywhere, isn't panic selling sometimes just logically trying to stop the bleeding? Like bailing out of a burning plane?
What's fascinating here is the distinction between a calculated strategic exit and emotional panic.
Okay, break that down for me.
A strategic exit is realizing the fundamental business model of what you own is permanently broken. Say, a company whose entire global supply chain was just sanctioned. Exiting that position is triage.
But panic selling is different.
Panic selling is jumping out of the airplane just because you hit severe turbulence. It feels terrifying, the cabin is shaking, but the structural integrity of the plane is actually fine. In a crisis, initial market drops are driven by algorithmic vacuums and massive overreactions.
So if you sell into that, you're just locking in a permanent loss. You convert a temporary paper loss into actual permanent destruction of your capital.
Yes, you are emotionally driven to sell at the exact bottom. And that leads right into the second trap: following hype. Because once you lock in that massive loss, you become desperate to make it back quickly.
So you start looking for lottery tickets.
Exactly. You start following hype into obscure, highly speculative assets or miracle investments. Opportunists always prey on retail investors during hyperinflationary periods.
People want a quick fix because the slow process of dividend reinvestment feels too painful. And I guess that triggers the third trap, right? Failing to diversify.
Right. You take whatever money you have left and put it all in one place. You concentrate it into a single, highly volatile position, hoping for a bailout. And if you're wrong just once, it compounds the damage and leads to total financial ruin.
You throw away the compass and the water rations to buy more lottery tickets. It's wild how our brains work against us in these moments.
It really is. Which is why having the discipline to just do nothing is often the most valuable skill you can have.
So, as we wrap up this deep dive, I think the core ethos from the final section of these notes is incredibly clear. The ultimate goal is to stay calm, stay prepared, and make smart financial decisions. Preparation really is the antidote to panic.
I completely agree. And I want to remind everyone listening, while we obviously hope 2026 and beyond remains completely peaceful, building this kind of financial resilience protects you no matter what. Having emergency savings, reduced debt, and diversified investments helps you regardless of whether a global conflict occurs or just a personal financial hiccup like a job loss.
It's just fundamental structural hygiene.
Yeah.
But, I want to leave you with a lingering question that wasn't explicitly answered in the notes, but it's really been sitting with me. Think about this. If surviving a severe global crisis requires us to retreat to essential sectors and government bonds,